Hi everyone! Have you ever wondered how companies manage their expensive assets like buildings, machines, or vehicles on their financial statements? Well, you're in the right place. In this video, we'll break down the essential of fixed assets, how they're recognized, and the methods used to depreciate them over time. Let's get started! Fixed assets are valuable items owned by the company that are used to conduct business activities such as buildings, machinery, computers, or vehicles. These items are not bought for resale, but for use over a long period of time, usually more than 1 year. As they continue to be used, the value of fixed assets will decrease over time, and this is called depreciation. Fixed assets are important because they help companies operate and make a profit. Fixed assets are recognized when future economic benefits can be obtained and their value can be measured reliably. Recognition of fixed asset will be very reliable when the fixed asset have been received or transfer ownership rights and or when they are controlled. The criteria for being recognized as a fixed assets are: first, tangible; second, has a useful life of more than 12 months; third, the acquisition cost of the asset can be measured reliably; fourth, not intended for sale in the normal course of the entity's operations; and the last, acquired or constructed with the intent to use. Initially, fixed assets are recorded at cost. This includes the purchase price, delivery, installation, and any other costs necessary to make the asset ready for use. Depreciation is the gradual decrease in the value of a fixed asset over time. As assets like machines or vehicles are used, they wear out or become outdated. Depreciation helps match the asset's cost with the income it helps produce, and also keeping financial reports fair and accurate. There are several methods to calculate depreciation, and each one spreads the asset's cost over time in a different way. Now, let's discuss these methods one by one. The most common method is the straight line method, where the asset loses the same amount of value every year. This method is characterized by the same amount of depreciation each year and also best for assets with consistent value loss like furniture and buildings. The formula for this method is asset cost minus salvage value divided by useful life on an asset. Here's a breakdown of the components. Asset cost is the initial purchase price of the asset. Salvage value is the estimated value of the asset at the end of its useful life, and useful life is the estimated period the asset will be used by the company. Another method is the declining balance method, which charge more depreciation in the early years and less in the later years. This method best for assets that lose value quickly like vehicle and technology. The formula for this method is book value beginning of year multiplied by 2 and divided by useful life in year. Here's a breakdown of the components. Straight line depreciation rate is calculated as 1 divided by useful life of the asset. Book value is original cost of the asset minus accumulated depreciation, or the total depreciation expense recorded up to that point. In simpler terms, first, calculate the straight line depreciation rate. Second, double that rate. Third, multiply the double rate by the asset's book value at the beginning of the year. And last is repeat this process each year adjusting the book value for the previous year's depreciation. There's also the units of production method, where depreciation depends on how much the asset is actually used. This method is based on how much the asset is used and useful for assets whose wear and tear directly related to their usage, like machinery and equipment. The formula for this method is cost of asset minus salvage value divided by estimated units of production and multiplied by actual units produced. Here's a breakdown of the formula. Cost is the original purchase price of the asset. Salvage value is the estimated value of the assets at the end of its useful life. Estimated units of production is the total number of units the asset is expected to produce during its useful life. And actual units produced is the number of units that assets produced during the specific accounting period. The last method is sum of years digits, which is an auxiliary method for calculating an asset's depreciation. It allocates a larger portion of the asset's cost to depreciation in the early years and smaller portion in the later years. The formula for this method is remaining useful life of the asset divided by sum of the year's digits multiplied by depreciable cost. Here's a breakdown of the formula. Depreciable cost is the cost of the asset less its residual value. Remaining useful life is the year in which the asset is depreciated. For example, first year, second year, and etc. A number of years is the sum of all the numbers of years in the asset's useful life. For example, for an asset with a useful life of 5 years, the number of years is 5 plus 4 plus 3 plus 2 plus 1 equal 15. At the end of each accounting period, companies record depreciation through a journal entry. This entry reduces the asset's value and recognizes the expense. The typical journal entry is depreciation expense in debit and accumulated depreciation in credit. Depreciation expense appears on the income statement, while accumulated depreciation is shown on the balance sheet as a reduction to the asset's value. Let's look at an example. A company buys a machine for 10 million rupiah and decides to depreciate it by 1 million rupiah, each year using the straight line method. At the end of the year, the journal entry would be: depreciation expense is debited by 1 million rupiah and accumulated depreciation is credited by 1 million rupiah. This entry records the decrease in value and the expense for the year. Over time, accumulated depreciation will grow while the book value of the machine goes down. Before this video ends, let's summarize the material that has been explained earlier. To sum up, fixed assets are long-term resources used in business operations such as buildings, vehicles, or machines. To be recognized as a fixed asset, the item must bring the future benefits and have measurable costs. Over time, fixed assets lose value, and this is recorded through depreciation. Different methods like straight line, declining balance, or units of production help spread the asset's cost fairly. Each method has its purpose, and companies choose based on how the asset is used. Thanks for watching! We hope this video helped you understand the basic of fixed assets and depreciation.